most active funds underperform their benchmarks. Most hedge funds fail. So how come a few people have been able to so drastically outperform everyone else? I pulled together examples of some of the most legendary investors. Some who have played slow and steady, spending a lifetime of reliable performance to get to the top, while some took massive high-risk swings and knocked it out of the park. This is a collection of the stories and the methodologies, the philosophies behind the people who have been able to be enshrined as the legends of investing. The one I'm starting with is one that I assume is a very well-known figure to most people here. Warren Buffett, born in 1930s Nebraska, is one of the most successful investors and businessmen in all of American history. He has built an enormous corporate enterprise and enormous personal wealth through his business, Berkshire Hathaway. Beginning as a child, he found odd ways to make money, finding little business ventures and things to sell, and he had a keen mind toward it very early on. But it was while he was in business school that he really built his core philosophy. He studied at the Wharton School of Business and was heavily drawn towards the ideas of Ben Graham, the concept of value investing. There are many different ideas in the broad school of thought that is value investing, but at its core, its premise is it's about how much you pay for an asset. The idea is to buy an asset when it is trading below its intrinsic value. Warren developed Ben Graham's ideas into his own approach to investing, where he targets companies that trade at low multiples, show reliable growth, have strong management teams, are very well-regarded brands, have a large competitive moat, get high returns on equity, and have stable high cash flows. Cash flows which he has often used to invest into new companies. A prime example of this being his acquisition of Geico. Early on, he met Charlie Munger, a man who was also interested in the same philosophy of investing, and a man who would become his business partner to build Berkshire Hathaway into the behemoth that it is today. His investment approach was so successful, and he was so respected as a businessman, that in 1991, when Salomon Brothers was embroiled in the Treasury scandal, he was invited onto the board. He accepted it, and his testimony before Congress, where he discusses integrity, very likely saved the investment bank, something that would not have happened if it weren't for just how well respected he was. In the 2008 financial crisis, he did something similar, but on a much greater scale. He took a large position in Goldman Sachs. He publicly said that he's buying American, and he guaranteed loans. He was at the scale of financial power and respect that he was able to fill a role that looks very much like what J.P. Morgan the man did about a century earlier. Today, Berkshire Hathaway's largest investment positions are Apple, American Express, Bank of America, Coca-Cola, Chevron, Occidental Petroleum, Kraft Heinz, Moody's, Chubb, and DaVita. Over his life, Warren Buffett has shown that a careful and patient approach to value investing can yield extraordinarily gigantic results. This next figure is an incredibly impressive investor, but also a very accomplished figure in fields outside of finance altogether. Jim Simons was born in 1938, Cambridge, Massachusetts, and studied math at MIT, later going on to get a doctorate at Berkeley. He primarily worked in geometry, and after obtaining his PhD, he began to work with Sing Churn. Now, I'm not quite sure what the overlap will be on a video about investors with people who study math, but if the names Churn and Simons sound familiar together, it's for a very good reason. The two worked together studying the geometry of manifolds, leading to the discovery of the Churn-Simons characteristic, The Chern-Simons form also has significance in physics, so before we've even gotten into the investor story, we can already see that Jim Simons is a very capable and intelligent man who has made substantial contributions. After that, he went to go work at a place that doesn't exist, cracking codes that may or may not exist. And after some disagreements about the Vietnam War, he left to go work at Stony Brook, a school that for the rest of his life he would frequently contribute to. And it was while working there that he began to get into investing. He initially begins with a small hedge fund, and it doesn't do well. But he believes that he can use his understanding of math to find patterns in how the markets work. Initially, his strategy involved more manual trading, but over time he developed statistical systems and just kept improving and improving them until eventually he ended up with a money printer. So at this point, he has Renaissance Technologies, he has a good hedge fund, and it's doing well. Now, specifically what I said was a money printer. And this is what I mean by money printer. Oh wait, those aren't the returns. Those are the net of fees returns. Here are the returns without the fees. Yeah, extremely high fees. But that really doesn't matter because the returns are so huge that it's like you have normal fees in a fund that's doing unfathomably well. So, how'd he do it? Well, I don't know. I don't know if anyone knows. I don't know if anyone there knows. I don't even know who knows who knows. You know? Over years, Renaissance Technologies built an incredibly sophisticated set of statistical systems. And this was early on in the days of quantitative hedge funds, so it was a relatively new phenomenon. And as more funds entered, and more kept being developed, new systems forced new innovations, Renaissance Technologies, and specifically the Magellan Fund, always managed to stay on top. The firm today continues to hire from the likes of mathematicians and physicists and statisticians, generally foregoing people with traditional financial backgrounds because ultimately this is a complex statistical model that's driving all of this. Renaissance Technologies remains open to new investor money, but not for the Magellan Fund. They have other institutional funds that are still accessible, but that money printer now is closed and is only invested in by employees of the company. One little story of Jim Simons that I want to end with came from an interview that he did with Numberphile, where he was being asked about whether he wished he had stayed and focused entirely on math instead of becoming a businessman. He expressed no regrets and seemed very happy with how his life went. He was asked if he'd trade it for this or trade it for that, and consistently, he said that he was very happy with his life. But when asked if he would trade it, if he could be the guy who could either prove or disprove the Riemann hypothesis, he said, well, I'd probably trade some of it for the Riemann hypothesis. And that is Jim Simons. This next figure, Peter Lynch, might not have gotten the gigantic returns of the Magellan Fund, but the returns that he did get, considering what he had to work with and the constraints that he was under, makes him a truly legendary investment figure and one who absolutely deserves to land on this list. Peter was born in 1944, Newton, Massachusetts, and he was very interested in things like history and philosophy. He also worked as a golf caddy, and this element will come back up later in the story. He went to Boston College to study history, philosophy, and psychology, and it was there that he traded his first stock. He bought shares of Flying Tiger Airlines, which ended up more than 10xing in price. He would frequently refer to stocks like this as 10-baggers, and would spend much of his life attempting to find those. Still, this was just personal trading, and at the time he didn't have a particular interest in going into finance. That was until, when working as a caddy, he was offered an internship by the man he was caddying for, George Sullivan, the president of Fidelity. And that internship would soon become a full-time job, where he would work in research, and he would work his way up in the company, eventually becoming the head of research. Now, at this time in the mutual fund industry, the idea of rock star mutual fund managers was beginning to emerge. One Fidelity portfolio manager, Jerry Ty, became legendary for his momentum strategy, one which he was very fundamental in the pioneering of. And now, Fidelity was offering Peter the chance to run his own mutual fund, the obscure Magellan Fund. The fund was small and not well known, almost seen as a way to test Peter's abilities. It was long only and a mutual fund, but it was unconstrained in terms of what stocks he was able to buy for it. And he certainly proved himself. The fund did fantastic, becoming a rock star manager of his own. In fact, it's probably safe to say that he's the best-known rock star mutual fund manager ever. So how did he get so much success in investing? Well, in his case, it's somewhat difficult to articulate. He writes about his investment philosophy in his book, One Up on Wall Street, which is a book I thoroughly enjoyed reading. And he tells stories of successes and mistakes. He gives ideas. But to ultimately boil down what his philosophy was, it's buy good stocks. His most fundamental message was invest in what you know. He would invest in companies of products he liked using, ones that locals enjoyed. Now, of course, he looked for good classic fundamentals, but it really came down to not being afraid to hold, even when other people are getting scared, and remembering that a share isn't a lottery ticket. It's part ownership in a business. One thing that he believes allowed him to really stand out is that he didn't think about it like an MBA. He relied much more on his study of psychology, history, and philosophy, considering that ultimately economies and markets are social phenomena. He didn't believe in market timing, didn't believe in academic theories, and he didn't believe in fad strategies. What he believed in was GARP. GARP is a simple premise: growth at a reasonable price. You want a company that's going to grow, and you want to pay a reasonable price for it. The annualized return of the Magellan Fund when he was running it was 29.2%. Now, that might not sound as grand after talking about the Medallion Fund at Renaissance Technologies, but that does put it as one of the most successful investment funds ever. And keep in mind that he is doing this in a long-only mutual fund. That's unbelievable. So while it's hard to spell out directly what his strategy was, it's more of an approach than anything. He brought himself to the status of financial legend, not by any sophisticated rules, but just by looking at a company he liked, looking at something that he knew customers liked, seeing something that he believed in. And this points to the idea that good companies are the ones that ultimately win. And he was neither afraid to swing for the fences and hold on something he believed, nor to drop when it wasn't working. So the lessons from him are: ignore the noise, study more than business and finance, have the confidence of conviction, and most fundamentally, invest in what you know. This next one is the one that I've spent the most time reading and listening to, and he's really remarkable in his thoughtfulness. Howard Marks was born in Queens, New York in 1948. He studied business and finance and did very well academically. He also, however, studied Japanese, not just the language, but the culture and history, and this is something he mentions frequently in his writings. After finishing business school, he went to work at Citicorp, where he did equity research, and he did very well there. And for him, it looked like he was going to be an equity researcher or equity investor, something in that realm, until he was moved over to the fixed income department. Now, at this time, bonds were thought to be pretty boring. No one got much excited in bonds. It was the 40% of the 60-40, and that thing you had in there for safety and didn't think much about. But this was at the time that high-yield bonds, termed junk bonds at the time, were starting to get a second look as something that might actually have some real potential in them. And it was the perfect place and perfect time for a thoughtful guy like Howard to get involved. After leaving Citi, he went to work at TCW, investing in high-yield and convertible bonds. It was here that he would meet the guy who would become his business partner, Bruce Karsh. They began to realize that there was quite a lot of potential in high-yield bonds, since many of them weren't being heavily scrutinized and were just thought of as, oh, those debts that, maybe they'll pay, probably they won't. He was able to find that there were some really solid investable opportunities if one was able to take the time to research and understand the situation of the issuer and the obligations in the bond covenants. With this opportunity set and insight, in 1995, Howard Marks and Bruce Karsh started Oaktree. Oaktree was set up as a multi-asset fund that primarily focused on fixed income, and today has quite a wide array of investment strategies. He and Oaktree have done very well with his philosophy that over the long run, getting steady, reliable returns, protecting from major losses, will outperform taking big, risky trades, hoping that that gives return. Now, he is not a risk-averse investor, but his philosophy primarily focuses on risk. That risk is what can be controlled, not return. So a good investor should focus on the risk end of a portfolio. Now, fortunately, we can say pretty solidly what his investment philosophy is, because he has written an enormous amount of material. His book, The Most Important Thing, outlines many of the major precepts that form his way of thinking about investing. In his book, he writes that the most important things are second-level thinking. He posits that many investors have a very surface-level way of thinking, and that the only way to really get an advantage in the market is to be able to think on a deeper and more nuanced level, understanding market efficiency and its limitation. He believes that markets are efficient in the sense that they are able to accurately reflect the aggregate sentiment of the market participants, but that they are inefficient in that market participants are very often wrong in their views. Value. He believes that it's very important to know what something is worth. In this sense, he has much agreement with the philosophy of value investing, shared with great investors the likes of Warren Buffett, Ben Graham, and Seth Klarman. The relationship between price and value. Finding the intrinsic value of an asset is all well and good, but you have to find one that you're able to buy at a price that is reasonable considering that intrinsic value. Understanding risk. Now, Howard Marks is not risk-averse, but he is very risk-careful, and much of his investment consideration focuses on the trade-off between potential return and risk. He states that an investor must be mindful that when seeking return, risk must be taken on as well, and he holds that the correct place to focus is on the risk side and not on the return side. Recognizing risk. He states that many people often fall into traps of believing things to be much less risky than they are, and that a good investor must always be mindful that the future is uncertain, and to be mindful of what risks may be lurking just below the surface. Controlling risk. And this gets to the fundamental premise I was discussing earlier. Many investors have had fantastic performance years, but so too do many have gigantic losses. And a 10,000% return year doesn't mean all that much if next year you're wiped out. So from Howard's perspective, the mindful control of risk level is one of the most key factors in investment success over the long run. Being attentive to cycles. Howard discusses cycles like the business cycle, the credit cycle, or hype cycles. And while his position is that the ultimate way a cycle will play out, and precisely when it will play out, is unknowable, being mindful that cycles do occur and not taking your eye off of that will set an investor apart from others who become negligent of it. Being aware of the pendulum. He writes that markets swing from extreme greed to extreme fear, and that while similarly to cycles, the when and how is not predictable, it is very important to remain mindful of those massive swings that occur from one end to the other in a market. Combating negative influences. He writes that investors are often swayed to get wrapped up in the hype and greed of a massive boom, or to despair and panic along with a massive sell-off. Very often, emotional reasons cause investors to deviate from what they know to be the correct course of action, and he stresses the extreme importance of being mindful, sticking to what an investor believes is the correct thing to do, and not getting caught up in those emotional pitfalls. Contrarianism. Now, he isn't saying that doing the opposite of whatever the market is doing is a surefire strategy, but he is saying that an investor should consider that sometimes the market may be wrong, and that a successful investor thinks that extra level deeper and is willing to question the crowd, and more than that, has the confidence and conviction to walk the opposite way as everyone else. Finding bargains. He writes that finding the cheapest stock might not necessarily be sufficient to get better returns. Investors need to be mindful of their needs, requirements, and tolerances, and first factor those in. Once those have been factored in, then trying to find the best discount is the step after that. Trying to find a bargain on what the investor needs, not just a bargain for bargain's sake. Patient opportunism. Those great deals may not always be there. And this is the idea of don't swing at every ball that comes your way. Sometimes the best approach could be just sit it out and hold, and not to go in on something just because it looks like it's the best one that's there, but to wait for the best opportunities to arise and be patient, because the better ones may come along unpredictably, and there may be some waiting time in between them. Knowing what you don't know. Knowledge is a very important thing to have in investing, but it's also extremely important to know the limitations of your knowledge, and more than that, to know the limitations of knowledge in general. He writes often of people placing great confidence in prognosticators and models that claim to be able to say what will happen in the market, when in reality, often these things are unknowable, and a good investor knows where knowledge ends and guess begins. Being aware of where we stand. Now, he doesn't believe that one can predict the future with any great accuracy, but does write that rough estimation of where things stand in a cycle, where things stand in pricing, where market sentiment is, can be estimated, and having a general sense of that can really give a great degree of aid to an investor. Appreciating the role of luck. Very often an investor will get an incredible return from some trade. Now, while that's great for the investor, it could also be dangerous, because if that investor just got lucky and now starts to have undue confidence and claims to be a genius of the market, that could become disastrous later on. So it's very important to recognize that sometimes things are just luck. Sometimes things are out of our control. Investing defensively. He posits that the best offense is a good defense, and since one can't get return without taking on risk, and can't avoid all risk and get return, once an investor has found the appropriate risk level, the investor should be defensive. It's better to avoid those losses and steadily get the gains at the level of risk than trying to jump out and catch something that could end in disaster. This echoes Warren Buffett's line, the first rule of investing is don't lose money. And this is so fundamental to Howard's whole philosophy. Staying steady and controlling risk over a long time horizon is likely to be much better than trying to get big returns. Avoiding pitfalls. As mentioned earlier, there are a lot of common pitfalls that investors fall into, like extreme greed or extreme fear, or the desire to go along with the crowd and start doubting themselves too much. It's important for an investor to be aware of those pitfalls and to have enough sense of self to know what one's own particular pitfalls are. This takes a degree of introspection and conscious cognizance. Once an investor can identify what pitfalls they might be susceptible to, then they can start to be addressed. Because those pitfalls can have major negative repercussions for an investor if they've gone unchecked. And often, they'll go unknown by an investor who doesn't take the time to reflect on what might be particularly affecting them. Adding value. An investor can always track the market. There's always the index fund. But for an investor to add value, an investor needs to have some ability to go beyond what the market could do on its own. So an investor needs to have insight, needs to be thoughtful, needs to avoid those pitfalls, needs to be a second, third level thinker, be willing to be a contrarian, and to learn. What really sets an investor apart is how that investor thinks. In the last chapter of his book, he sums up all of the ideas from earlier. An investor needs to be analytical and needs to do things based on real data. But most fundamentally, a really good investor needs to have unique thought. An investor who thinks differently and thinks carefully can do fantastic. Howard's own thoughts and the ideas of Oaktree Capital are available in written and podcast form in The Howard Marks Memo and Oaktree Insights. They're definitely things that I enjoy listening to, and I think that they're fantastically useful for anyone who's interested in investing. George, I'm not even quite sure where to begin with George. He's a whole different animal altogether who had much more of an intuitive understanding, and one that was very philosophical. He was born as Georgi Schwartz in 1930s Budapest, Hungary, which was not a fantastic time and place to grow up. As a young child, he was caught right in the middle of the Second World War. And in the 1940s, while under German occupation, he was tasked with handing out deportation notices. Now, at such a young age, he didn't fully recognize the implications of handing out these notices, but has also remarked that he has some very fond memories of those times in his childhood. I'll just note that listening to George, he is absolutely wild to listen to. All throughout the occupation and the war, he made it through by pretending to be a Christian Hungarian. Of all the people I've covered in this video, he by far has the most wild origin story. After the war, he left to go to England to study at the London School of Economics, and there he was particularly drawn to philosophy. In fact, he's remarked that for quite a while, he intended to pursue a life of academic philosophy. He studied under Karl Popper, where he became very supportive of the idea of internationalism. Something which wasn't new to him, as his father was the editor of an Esperanto magazine, something which he grew up learning to speak. And after that, he just started doing some odd jobs. He still had an interest in the philosophical end of things, but wasn't really making much money. So he began to take much more seriously the idea of a career in finance, just long enough so that he'd be able to save up enough money so he could live the life that he wanted. The only problem, he didn't know how to get in. There were no job application websites, he didn't know anyone, so he sent mail to the managing directors of every merchant bank that he could find, eventually securing a job. He worked there, and later at other brokerage and trading firms, primarily working in arbitrage, and it was while doing this that he came up with his most significant idea. George's most lasting idea has certainly been reflexivity. He writes about reflexivity heavily in his book, The Alchemy of Finance, and much of his thinking was informed by the study of alchemy. Reflexivity is a fundamentally alchemical concept. The idea that he formed is this. Say you have a stock of a company that's not really doing well, but all of a sudden, some news comes out that makes it sound fantastic. Now, this could just be a minor bit of news that doesn't actually mean all that much. But, still, traders start buying shares because of that news. Well, now the financing costs are different for the company, there's momentum to the stock, people see the stock is going up, and now this gives quite a lot of benefit to the company. So now the company can start investing in more projects, and now the company can do better. So that means the company is actually better. So the stock is now worth more. So people will begin buying more and more, and the company does better and better. It's a self-reinforcing mechanism. Likewise, this can also work in reverse, where something begins to push something down, and the very act of going down makes it go down further. And this isn't limited only to stocks, but any security in general, and also societies. In 1969, he starts a hedge fund from a few investors that he knows, and he does quite well with it, getting enough capital to form Soros Fund Management in 1970, which trades global macro strategies. And it's really unconstrained, and it's really successful. He would think so differently than people around him, taking completely opposite positions from the rest of the market. He seemed to have just an understanding of how things worked on a level that was not matched by the rest of the market. And he made phenomenal returns with that. Now, he has great trades to talk about. Trades when going off the gold standard, trades in Asia. But there is one that is so much more legendary than all the rest. The pound trade. His pound trade did not make him many friends, to the point where people have accused him of intentionally destroying the British economy. The United Kingdom was in the European exchange rate mechanism, and he found that the relationship between the British pound and the rest of Europe was completely out of balance. So he started building up a position, going long German marks and short British pounds, and ultimately it paid off very well. He had shorted billions of British pound. In fact, it paid off extremely well because it was so heavily levered. There's a story of him talking with Stan Druckenmiller, someone who I will discuss in a later video, who talks to him about the idea. And when considering it, George says, how about instead of putting 100% of the fund in the trade, we put 200% of the fund in the trade. He levered the whole fund 2-to-1 for this one trade, and it absolutely won, and the pound was crushed. There are so many stories of his trades, and they were remarkable. His book is also very worth reading, but George isn't primarily thought of as a hedge fund manager right now. He's thought of as a mysterious, shadowy money man. So remember how I discussed that he was very drawn to the idea of internationalism? Well, he was very, very drawn to the idea of internationalism, putting an enormous amount of money toward political endeavors designed to foster specifically that. Much of his worldview has been shaped by Karl Popper and his idea of the open society, to the point that George wrote a book about why he believes what he believes and does what he does. And he also started a foundation, both called the Open Society. And that book's also certainly worth reading, but to sum it up, it essentially comes down to liberal democracy is the best system ever, and the countries of the world and international markets need to be more globalized. He has put a lot of money into projects around the world, leading some world leaders to be very unhappy with him and considering him an enemy of their country, speculating that he put in a bunch of money to profit at their expense. Now, while we can't know exactly what his intentions were, it is safe to say that he has many friends and many enemies around the world. His commitment to internationalism, liberalism, and the open society do seem to be very sincere. But if there's one thing I can say for certain about George, it's that he knows exactly how to use money.